Hey guys, this is Charles Weeks with a Barrister Minute. Today I want to talk about the true cost of being wrong. And what do I mean by that? There's a great story about Warren Buffett complaining about his $300,000 haircuts. Warren Buffett didn't view his money presently. He always viewed his money in terms of what their future value might be. So for him, spending $10, $20 every month on a haircut, in the long term, it was going to cost him a lot more than just that $10 or $20 haircut every month. He was always looking at what those future dollars would really be worth versus what the present dollar cost was. So we had talked a lot in previous writings and conversations that we've had regarding elections and trying to time the market. A lot of people were told, hey, get out of the market, sell. There's going to be a bunch of different things that can happen, contested elections, a blue wave, different tax plans. We recommended staying the course. What would have happened if you had sold out of the market on, let's say, November 3rd? A lot of different dates you can choose, but for this analysis, we need to choose some date. So let's assume the last possible time, Monday, November 3rd, you decided to sell out of the market. Since that time, a 60-40 stock and bond portfolio is up 4.76%. So what is the cost? What is the true cost of being out of the market, being wrong, and trying to time the market? If you had $1 million portfolio, you would be down $47,600. But it's not so much about what you lost now in present dollars, it's about what you really lost over time. So let's assume that you would have kept the money in the market, it would have stayed invested over the next 10 years, 20 years, and 30 years at 6%, what would those future values have grown to? You might be surprised to learn by being out of the market just over this short time period, the few weeks that you've been out of the market, with $1 million portfolio over the next 10 years at 6%, you would have over an $80,000 difference in your portfolio if you would have just stayed invested. If you would have had a 20-year time horizon, the number would have been even greater. It would have been closer to a little over 150,000. And if it's over a 30-year time horizon, the number is even larger, as you can imagine. It's greater than 270,000. So the true cost of trying to time the market and being wrong isn't just what you missed out on over a few short weeks. It's how what you missed out on over those short few weeks is going to compound over time. That's really what we want to stress, and we really want to stress how difficult it is to try to time markets. You not only have to be right getting out, you have to be correct about when you're going to get back into the market. So like Warren Buffett, we believe it's not about present values, it's about future values for your dollars. We like to look more long-term, and we like to invest according to an investment policy statement, investment strategy that stretches over 10, 20, 30-year periods, not short-term time frames. Hope this helps, and looking forward to talking to you again in our next Barrister Minute. Take care.